Well, I was rooting around at Silver Doctors because a little headline caught my eye. And it was about Martin Armstrong explaining the next crisis that is certain to come. In a nutshell, it's all about confidence. And in his cycles, it talks about the end of confidence, the confidence cycle for people to their government. We're losing confidence in our government, and once confidence is lost, that's when things go sour. Because people no longer believe them, they don't believe the fluff, they don't believe the hopium smoking for hope and change. And markets, simply put, will start going down because of the loss of confidence, period, amongst other reasons. So somebody asked him a question, and this is great because I was like, Tampa? I'm from Tampa. Who is this guy, right? Who's this guy asking the question? And this is from Martin Armstrong, his site, but it was posted on Silver Doctors. Question, Martin, I started following your models shortly after college in 2000. When I entered the financial advisor world, I soon realized how clueless this industry was and formed a hedge fund in Tampa in March of 2007 to short retail and housing, largely based on your models and my understanding of cycles. I reached the top 1% in Morningstar through September of 2008, right up until the government banned shorting. I could not receive quotes from my Goldman Sachs trading platform, and I lost a lot of money in a few short hours. I eventually had to shut down the fund, and my investors took losses. It was this period where I learned the error in my thought process. I underestimated the length to which the government and politicians would go to kick the can further down the road, and underestimated the big banks' inside influence on the so-called free markets. Your recent post regarding inflation and the end of quantitative easing had me thinking, wouldn't the moment the politicians realize there is a recession on the horizon and inflation begins to cripple the housing, followed by retail, etc., wouldn't they reinstitute quantitative easing and expand the balance sheet even further, regardless of the future implications? It seems politicians will do whatever it takes to avoid the worst and continue to kick the can down the road to save their own careers. Thank you for your provoking thought and mindful awareness while everyone else buries their heads in the sand. Answer. The outcome always depends upon confidence. It is what you believe that counts rather than the facts. When credit and salt went belly up in 1931, why did an obscure bank in Austria set in motion the 1931 panic and sovereign debt defaults that made a recession into a Great Depression? The answer was found in the name. One of the owners was the Rothschilds. When people heard that the Rothschilds went bust, they began selling all the banks because if they went down, everyone else surely would. They were the Goldman Sachs of the day, they as in the Rothschilds. I suggest reading Herbert Hoover's memoirs from 1931. This is a confidence game. Just because QE appeared to work before does not mean it'll work a second time. The middle class lost money and their living standards were sharply reduced. Retail investment in equities has not yet returned to even 50% of 2007 levels. Most people who lost their homes were those who could never have bought one before in the first place. Yes, the middle class who borrowed more against their house were put under stress. Home equity loans dried up, so industries like selling pianos dropped by more than 50% since people borrowed using home equity to fund expensive things like a piano. The difference this time is the fiscal budget. Back in 2007, the Fed only had to worry about its policy in the contracting economy. The problem they created is that government just keeps going like the pink Energizer Bunny. It never stops spending regardless of the level of interest rates. The Fed cannot neutralize the fiscal spending of the government. This is deeply entrenched. Just look at the table below, which I'm going to put up, on the annual deficit since 2007. This has increased about 364% since the 2007 crisis began. Government has become addicted to cheap interest rates. If rates go back just to 5%, we are looking at a fiscal deficit explosion the Fed cannot overcome. So 2007, 161. Again, this is like in billions or whatever it is. U.S. fiscal deficits annually. 2008, you see it explode. 2009, even higher. 2010, 11, 12, 13, it's down a little bit. 14 is down a little bit. 2015 is down, up. 2016 is back up. He says the crisis has to hit before a politician would ever act, right? That's why they're always reactionary. I always talk about this. They're always reactionary. Yet other people, we can see this coming from a mile away. That's a bad decision. Don't do that. Don't allow anybody to just sign off saying they have a job and that they make bukus of money and then allow them to have a house without checking, without making them prove this is the case. Nope, we're just going to do it. Easy spending, easy money. Everyone should own a house. Again, Obama and Bush and Obama, everyone should own a house. But again, most of that was done under Bush. And then, of course, before him, Clinton, who got rid of Glass-Steagall, made the banks turn into investment banks and combine into both. Or basically allowed banks to become investment banks and investment banks to become banks, whatever. And then they gambled on Wall Street at the same time and then lost the bet because the market started crashing and we had to bail them all out. So let's go back to the 5% thing he said. If government has become addicted to cheap interest rates, if rates go back just to 5%, just 5%, that's nothing. We're looking at a fiscal deficit explosion the Fed cannot overcome. So what I'm thinking, I mentioned this, was it yesterday or the day before? What if economic data the Fed has been looking at, which has been crappy this whole time, as you and I know, and they know it, but they keep telling us, no, it's good data, we got good data. Soft data, garbage data. And 90-something% chance that the Fed will hike in June. It's baked in the cake. It's a 90-something% chance all of a sudden. And then they're going to do it again later in the year. We may do it 3 or 4 times this year. But what happens if all of a sudden bad economic indicator hits? Oh, we're not going to raise this time. It's going to again, confidence, consumer confidence. The Fed, you've shown your hand. You're not going to be able to raise rates, and you knew it the whole time. So you did still 0.25%, another 0.25%. Oh, we're off to the races. Oh, wow, big whoop. We're going to do a third one. Oh, my gosh, they did another quarter. Oh, boy, we're really hitting them hard. What do we got? A single 1%, single point interest? When I got my house, interest rates were 6.5% back in 03-ish time frame. So we're talking roughly, and I don't know what the federal funds rate was at the time, but it's, somewhere around there. Certainly wasn't 0.25 or 1 single percent. So if rates go back up, it's game over. But rates have to go up. We can't keep rates on. They must go back up eventually. So if they don't go up, and Donald Trump wants to spend a ton more money, and boy, you heard him, he does, the Fed's going to have to find a reason to not raise interest rates and keep them down. Because remember, Donald Trump said at first about the interest rates rising, then he said, "Oh, Janet Yellen's doing a good job," and I think the Fed should keep try to keep the rates down. And, keeping the low rates is a good thing, and he changed his tune all of a sudden. But the Fed says, we still plan on raising in June so far. So I'm just wondering myself if the rates aren't going to rise, or maybe they do one more little quarter, up 1.25% now, up from 1%. And then, okay, never mind. We got to go back down. Some new data hit. It's not good. Anyways, the crisis has to hit before a politician would ever act. Once the crisis begins, you cannot restore confidence. The whole thing will have to play out. Moreover, the crisis in Europe helped to send capital to the USA, easing the economic pressure here, which I just discussed in my last video. This is why the USA is holding up the entire world economy right now, and a stiff wind will blow over the European banking system. I seriously doubt that anyone can stop the next crisis, and whatever they do will then be seen as a failure. During the late 1970s, the IMF held gold auctions trying to stop its advance. The first auctions in 1975 and 76 caused gold to drop by 50%. However, the continued auctions had no effect, and they were seen as a validation of the bull market that could not be prevented. We are looking at the same type of collapse in confidence this time around. The same fundamental act can have different interpretations. It is the glass half full or half empty thing. So that was his answer. Loss in confidence is all it takes. And we're supposed to be good numbers, the economy's recovering, but now it's not. Of course, it never was. But now the numbers that they try to fudge are even saying, nice try. Oh, and what was Apple? Now, I can't remember. Is Apple and S&P, one of the S&P stocks? Apple. S&P 500. Is Apple? Or is it Dow? Apple, S&P. Yeah. Apple drops a little bit. Didn't do as good of sales or some crap. If Apple goes down, S&P 500 lower after Fed leaves rates unchanged. Dow turns higher. What's this? What the hell is this? E-Trade. No thanks, E-Trade. Continue the website. S&P 500 lower after Fed leaves rates unchanged. Again, that was May 3rd. That's the day I'm actually doing this video. Stocks held mostly lower on Wednesday after the Federal Reserve's policy-making group decided to leave the federal funds rate unchanged. Right? We don't want to raise the rates again yet. No. S&P was down 0.15%, and the NASDAQ fell 0.5%. The Dow Jones Industrial Average turned higher, climbing 0.07. Oh, that's worthy. The Fed opted to leave its federal funds rate at 0.75 to 1% at its May meeting. The group maintained its forecast for gradual hikes. The Fed did note that economic growth had slowed, though said the fundamentals still remain solid. In other words, stay confident, like the never-ending story to Atreo. Atreo, be confident. Be confident, Atreo. Atreo is the American sheeple. Atreo, be confident. Oh, the economy's not looking good, but be confident. Stay confident. Stay confident. The committee views the slowing in growth during the first quarter as likely to be transitory and continues to expect that with gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace, the Fed said in a statement. The odds of a rate hike to 1% to 1.25% at this meeting sat at a negligible 4.8% probability prior to the announcement, according to CME Group Fed Funds Futures. A June rate hike looks more likely with a 67% chance. I thought it was higher than that, I heard 2 days ago. The meeting on Wednesday concluded with no press conference, often taken by investors as a sign of no change in monetary policy. Despite weak GDP numbers and soft March payrolls, the Fed's target of 3 hikes in 2017 is still in their crosshairs. Oh, really? Speaking of E-Trade, said Mike Loengart, VP of Investment Strategy at E-Trade, which he wrote in a note. All eyes continue to be focused on the June meeting, and if the economy shows greater signs of life, no doubt the Fed hawks will be buzzing for an increase. But what if we can't get the Obamacare repeal and replace, and we can't do the tax thing, and the Trump train, hopium, it starts to really fade. It's already fading. It starts to really fade. Then what? And again, today's the 3rd. May 11th, I'm watching that date, that special dude, whatever his name was, who gets all the cycles right, says May 11th, we could have some really, really bad news for the market for some reason, just according to his cycles. Not sure the reason, just it's a big date for us, he said. So my question really would be, what happens if it's great news, fake or not, but great news about markets and everything else on May 11th? So is that his way of saying, well, if that's the case on May 11th, then we actually should coast by for a good while? Or is he saying, I'm not expecting any good news on that date, and it's probably not going to be, and it's going to lead to bad stuff, market-wise? Wasn't 100% sure on the interpretation, other than it is a very important date for the cycles, and it was the most important one he was talking about that he really needs to look at where we're at, where the market's generally going as we get towards that spot. And as you see, we have Dow up 200, then it starts going down, 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 up. Apple sucked, down, S&P down, down, up, back up, down again. So you have the, one step forward, 3 or 4 steps back. A big step forward, 2, 3, 4, 5 steps back. So we got about a week and a half to wait. We'll find out, won't we? Take care.